Thanks for joining us today for our Net Wealth Portfolio Construction webinar. This is our series designed to help you discover new investment opportunities and see wealth differently. Hi everyone, I'm Jo from the marketing team at Net Wealth, and we're delighted to have Michelle Lopez join us today from Aberdeen. She's going to share how to identify small cap stocks that will last the distance. Before I hand over to Michelle, we'll just go through some housekeeping. Financial advisors who've joined us will receive 1 CPD point. To receive this point, you'll need to be online for at least 30 minutes. You'll receive your CPD details within the week. This webinar is being recorded, so everyone will receive a copy of the session and slides via email within the week. You can also submit questions at any time via the questions tab in the toolbar to the right of your screen, and we'll have time to answer these at the end of the session. Please be aware that the information shared today is general advice only and is not intended to be professional financial advice. For those of you who don't know Net Wealth, we're an ASX listed company nearing our 20th year. Our purpose is to help Australians see wealth differently and discover a brighter future. We provide investors with a range of investment and super solutions via our platform, and investors can manage their super and investments using our portfolio tools. They can access a range of reports and online charts to analyse their portfolio and stay up to date with changes in the Australian stock market by accessing live prices and charts on individual stocks. Our platform also supports financial advisors with a range of financial products and services to help manage their clients' investments and super. I now have the pleasure of introducing Michelle Lopez. Michelle is Deputy Head of Australian Equities and joined Aberdeen in 2004. She's also a CFA charter holder and has a BA in Applied Finance, Commerce and Marketing from Macquarie University. I'll now hand it over to Michelle.
Thank you, Jo, and good afternoon to everyone listening in. I'll endeavour to finish up with a little bit of time, so please do jot down any Q&A, any questions that you've got, and I'll get to those at the end of the presentation. So today we're going to talk about 2 topics that I'm personally very passionate about. The first is the small cap part of the market, and then the second is governance, and why governance, particularly in this part of the market, is very important in setting up companies for the long term. Before we kick off, I was asked to just give a little bit of about who we are and what we do. So ASI, or Aberdeen Standard Investments, are indeed one of the largest investment houses globally. So we're managing close to $1 trillion in assets, and that's across a number of different asset classes. As you can see here on the left-hand side, it includes equities, fixed income, multi-asset, quant, and alternatives. My team, we're based in Sydney. We're responsible for approximately $1 billion of this, which is invested directly into Australian equities. So we do run a number of different portfolios, and they include large cap, mid cap, and small cap, with the focus today, as I mentioned, being on the small cap space. We do have a long and successful track record here. So we've been running a dedicated Australian equity portfolio for over 20 years and small caps for close to 12 years now. Time has gone very, very quickly. So honing in a little bit now on our equities, on the equities capability for the group. Post our merger with Standard Life, we now have 180 equity investors globally. And this is, the very exciting part of this is that we now have an investment footprint when it comes to on-the-ground analysts that rival some of our the better-known players in the market, such as the likes of Fidelity and whatnot. Even though the number alone is impressive, the real firepower behind this global research platform is in its consistency, the depth and the fact it's shared on one single technology platform. So as such, the insights are essentially kept and transferable. The other very unique aspect is the collegiate nature of our group. The fact that collaboration and idea sharing is rewarded and makes up a key component of our overall scorecard. Really speaks for itself as to the importance that we place on this behaviour within the group. So without further ado, let's turn to the topic at hand. And sorry, I did forget to change the slide. So that is the investment footprint that I spoke to, the 180 equity investors across the globe, and our team sitting under the Asia Pac region. So I've chosen to focus on small caps today for two main reasons. Firstly, they offer the greatest alpha potential, which I'd like to get to now with this chart. But the second part is, this arguably offer the greatest upside if they take on an active approach to governance. So let's take a step back and look at which part of the Australian equity market has the greatest scope to generate the highest alpha. There's a number of research papers published on this topic, and the key finding is this: the more volatile a market returns are, the greater the opportunity for an investor to add value. So in our case, we found this by modelling cross-sectional volatility since 2004 for the ASX 300, the X20 and the small caps. And taking a step back, actually, cross-sectional volatility measures whether stocks are moving together or they're divergent. And as it increases, so does the opportunity to both out and underperform the market. So if all securities perform in line with each other, the absolute returns are driven by macro factors, and there's really no opportunity for investment managers to add active returns regardless of their stock picking skills. Another way to look at it is that there's no idiosyncratic risk in the market. So what this slide is telling us is that the Australian small cap market has larger alpha potential than its large cap counterpart. And it's a pattern that's also been observed in US markets and other markets globally. So when you're considering the allocation of your fee budget, it really does make sense to employ active managers where they are most able to deliver the alpha. It's also important to understand the peculiarities of our market, and primarily that the Australian market is highly skewed. So what I mean by that is that there is a high concentration in very large stocks. If you look at the chart on the left-hand side here, it shows you that the top 20 names represent close to 60% of the index, or 57% to be exact. Now, for some context, the top 20 of the small cap index only represent 12%. On the right-hand side here, the sector concentration is also apparent. So you can see that the large caps, 50% of them are the banks and the miners. So by removing the top 100 companies, stock concentration is reduced and sector exposures actually change quite dramatically, becoming much more balanced. So the question is, why does this matter? And really, the core of it is that it provides a much richer and a more diversified opportunity set for investors to scope out those hidden, underappreciated companies. But here's the challenge, and that's that the risk profile also increases. With increased volatility comes greater risk of negative returns. Now, I find this a fascinating slide. It's telling us that more than half, or 53% of all stocks within the ASX Small Ordinaries Index posted negative returns over the last 5 years, and almost a third, so 31% of them, halved in value. Now, this is over a very constructive period. We've had cheap debt, we've had very strong underlying macro drivers and momentum-driven markets. And my view personally is that we're unlikely to see the same level of returns over the next 5 years, and that markets should return to more fundamental drivers. You know, for some context as well, if over the same period, only 20% of the top 100 companies have delivered negative returns, and only 2% of them have lost half their value. So you can burn a lot of money by taking punts on small caps, and this downside bias is something you should be very mindful of, and avoiding some of the blow-ups is probably just as important as trying to select those ones that are going to double in value. So the question then turns to, well, how do you do this? How do you avoid the companies that will destroy capital and invest in those that will provide the consistent returns? It's my very strong belief that success or failure is embedded in the fundamentals of a company. So there are a number of these factors that I look for when investing. They include ownership structure, the business strategy, and that of course includes the industry structure, financials, management, and ESG. ESG being environmental, social, and governance. So they're all of great importance when selecting high quality companies and constructing better quality portfolios. And I'm sure we'll get a chance as we progress through this conversation to talk to all of these to some degree. But at this point, I want to hone in on the final one, which is ESG, and in particular the G, so the governance. The reason for this is because I believe companies that adhere to good ESG practices are more sustainable, and therefore really offer a degree of future proofing. So whilst I engage and evaluate the environmental and the social factors as well, I focus on where we can have the biggest impact as an active manager, and that's very much at the governance end. Turning to the next slide of why ESG and why does it matter? So a good place to start, I feel, is with you, the client. You know, it's my primary responsibility as an active investor to generate the best long-term outcomes for our clients. Now, this involves incorporating ESG into the investment process alongside the other fundamental drivers I mentioned. Now, I don't want this to be confused with trying to cure the problems of the world. You know, that's far beyond me and far beyond the organisation I work for. However, there are some very positive side effects. So these include better allocation of capital, and by capital, I mean protection of your assets, people, the environment. And in addition, you know, clients are themselves focusing more on these and asking and looking for managers to take a lead. The second point I've got here is around the financial impact. Now, I counter the argument that ESG factors are non-financial. In fact, I believe that they are financially material and can impact corporate performance in a material way. So when they bite, they very quickly become financial. And I want to go through a real case study in the Australian small cap part of the market. But perhaps the best known one to date is what we saw with BHP and Samarco over in Brazil with the failure that they had at one of the dams. Now, that was an absolute travesty. The way that that company dealt with it was exemplary. They moved very quickly and closed down and sold any asset that they weren't the operators on. However, the financial implication has been material. So to date, between fines and remediation costs, they're looking at close to $1 billion. So again, just to show that these issues can be very financial. But I will talk to a local company as well. The third point here is understanding ESG risks and opportunities alongside other financial metrics allows better investment decisions to be made. Now, with all of this, what I'm trying to say here is that I regard ESG as a normal part of investment. To me, it really is common sense. Why would someone ignore factors and that could have a material impact on the future outcomes of a business? you need to really look at these issues when you're considering the long-term investment factors of each individual company. And the final point here really relates to active stewardship. So informed and constructive engagement helps foster better performance, protecting and enhancing the value of clients' investments. As an active manager, for me, it's really not just about stock selection. It's about engaging with the management teams, the boards of the companies that we're investing in. And I'm privileged to work for an institution with a unified investment philosophy around ESG. And what that means is that if we speak with one voice, we can really influence more positively rather than, you know, from it coming from a negative perspective and trying to influence by force. So companies that adopt good governance, not only will they build high quality, more sustainable businesses, but I believe will actually be re-rated and rewarded by the market as they see this driving through, coming through investor returns. We're often dealing with, when we talk to the small cap part of the market, I'd actually contend that this engagement on governance is even more important. We're often dealing with smaller management teams. Many are still founders, and they don't have the resources that the large cap companies do to allocate to this part of the market. So by guiding and by educating them at quite an early stage, they can really influence the governance culture and build that stronger foundation. This slide here is a bit of a, there's a lot going on here, but essentially we're trying to show how we do it at Aberdeen and how important corporate governance is to us. It's so important that it's embedded within our investment process. It's part of our quality filter, and it's a true area of differentiation within small caps. So how it works? We have a broader core stewardship and ESG investment team that acts as a centralised resource dedicated purely to ESG analysis and engagement, and they're available to all asset classes. So they also highlight themes and emerging risks within ESG. And this company sits up in the UK, and there's roughly, I think at the moment, 20 people reporting into Ewan Sterling, who's our head of ESG for the group. Then we have, so that's at the global level. At the regional level, so for us, the region being Asia Pac, we have embedded analysts on the desk. So up in Singapore, we have 3 dedicated resources to ESG. A 4th one is coming on. And then locally, we're fortunate enough to have Andrew Preston, who's actually based down here in Melbourne, as our head of corporate governance for the region. And Andrew has been engaging over a number of years with the directors, with the chairman of the boards of the companies that we're looking to invest in or are invested in, starting the discussion and dialogue and about how to move forward. So what have we been able to achieve? We have changed the composition of boards. We've put forward directors that we think have the superior skills and have had them elected to the board. We've been successful in campaigning for non-core asset sales to crystallise the value for us as shareholders, and they're really to sharpen the management's focus on what's core to their business. We've also, on an occasion, engaged with other shareholders where it's appropriate to agitate for change when it's required. So, you know, the corporate governance is an absolute critical element of our investment process because we know from decades of investment that it brings value to our investments. The challenge with all of this, which I'm very open about, is that it does take time. It takes time and it takes patience because these are behaviours that need to change within companies. So again, you can't go into it taking a short-term view. And that really resonates for us because when we do invest, it is taking a 3 to 5 year view, and we feel that over that time period, change can be made. Okay, I wanted to change gears a little bit here and perhaps just turn to a couple of local small cap examples of why ESG and governance in particular matters. I want to caveat this though, these aren't stock recommendations in any way, rather it's more a bit of an insight into our thinking around a number of local companies and how we've used governance as a tool to either invest or not invest in a number of these companies. So the first one we've got here is Dominos. I don't think Dominos needs any introduction. It's been a market darling for some time, given its very strong growth trajectory. Domino's has grown from, I think it was 800 stores back in 2010, and over the last 8 years, or 9 years now, it's grown to over 2,000 stores, and the majority of this growth has come from offshore. So offshore now represents 2/3 of the store footprint. And this is an example, I feel, of a company where ESG doesn't matter until it does, and the financial implications that brings. So what drove the share price to halve from $80 back down to $40? There was allegations that they were involved in wage manipulation and franchisees selling visa sponsorships illegally. And I always get asked, did you see this coming? And the answer is no, we didn't see that coming. I think that's very difficult to be able to do. However, there were a number of red flags with this business that we had flagged and also prevented us from investing. And I'd like to share a couple of these with you so you get a sense of what is sustainable and how governance really does play into a business like Domino's. So firstly, operationally, Domino's hadn't certified any of its facilities to globally recognised food standards, and it didn't comply to food safety management systems. So when your entire business is relying on this part of the market, it was, for us, quite interesting that they hadn't had that certification. The second part was high accounting risk. So what do I mean by high accounting risk? A couple of things here. Firstly, and I mentioned this, the majority of the growth had been through acquisitions. The second part is that they began providing vendor finance to franchisees to offload stores. And although these sales were quite a small part of the group, they were becoming a bigger proportion of their overall profits. And then the last part here around accounting risks is really that there was a number of related party transactions, which you always need to be very careful with as to whose interests are being met here. And then the final thing, the third part, was around the remuneration structure. So executives were, the pay of executives were heavily weighted towards EPS growth. So there was an incentive there for the debt-funded expansions and acquisitions. So pulling all this together, no, we didn't know that there were going to be allegations around wage manipulation and whatnot, but we had highlighted this as a risk around the governance framework of the business. The second example is cab charge. Now, I want to point out that this is a 10-year chart, so it's not just an Uber story. The share price doesn't look very pretty. I can certainly see that, but it could be at an inflection point. And the reason for this is this company has struggled with poor corporate governance since the founder, Reg Commode, established the group, pulling together all the various taxi operators around Australia. And you know, at a time when there was little competition, the group really prospered. However, I think it was back in 2014, Reg passed away, and that also coincided with the entry of a new player. So we all know Uber, and cab was unprepared for the challenge and the disruption that Uber brought to the market. So at this point, ASI, so we felt there was an opportunity to start engaging with management to introduce better governance framework and better utilise their assets. Now, over time, we have seen success with this engagement. The interim chairman was replaced by an independent chairman, and broader representation of independent directors were appointed. The board has broadened its skill sets, and there was quite a bit of replenishment and refreshment at the board level, which we agitated for. And they were able to pull together a new strategy to include the sale of assets and develop their own apps to compete directly with Uber. So ultimately, this company has become a much more nimble company. We've began to see drivers actually move back to cab charge that were previously with Uber. And again, this is an encouraging sign. What's resonating is you can't really have a career or a permanent job with Uber. It's more kind of at the fringe, whereas cab charge certainly provides that. With ARB, so ARB is an example of a company that it's not perfect from a governance perspective, but it is open and it's willing to engage and look to make improvements. So I think there is certainly upside to the story here. ARB, you know, one of the issues that I see almost universally with small companies is that they grow. As they grow, they're dominated by their founders, and who are by definition insiders in corporate governance terms. However, we can't automatically exclude them from being strong companies. So ARB, again, is a case in point where the founder, Roger Brown, owns a significant part of the business, and he's been pivotal in the success of the company. He's still very heavily involved. However, with our guidance, they've realised the importance of pulling back from the daily management of the operations, creating a path for succession, and the framework to encourage this through a very solid REM, so remuneration structure. We've also been speaking directly with the company around broadening the skills on the board and what's required for them as they start to generate a lot more of their growth from offshore markets. Again, understanding where the company is going is very important to framing what the board should be looking like. I've done it again. There we go. So tying this together, really the greatest opportunity to generate alpha within the Aussie equity small cap is the small cap is in the small cap opportunity set. I really feel that there's scope here for our future leaders. ESG absolutely matters, and at the very least, it leads to better informed investment decisions. I mentioned around active investor. So being an active investor, it's taken on a different light for me and for the group. And it's not just about stock selection that I have control over. I've also got control around the level of engagement that I have with the companies we're investing in and influencing change for greater foundations. So it is my primary responsibility to generate the best long-term outcomes for clients. And really, I feel this is through constructing a high-quality portfolio, providing better long-term risk-adjusted returns. Now, just mindful of time, I'd like to touch briefly, if I can, on how we do this in practice, and circle back to perhaps the other 4 fundamental factors we consider when investing in small caps. So this is really a high-level schematic of our bottom-up investment process. It doesn't do it justice. However, at its core, we believe quality investing works. So why is that? The market often systematically underestimates the sustainability of returns from high-quality companies. And the reason for this is high-quality companies, they have fewer tail risks and a greater margin of safety. They also produce less volatile earnings, and also earnings that are much more resilient and sustainable over time. And then the final fact here is that they can better navigate uncertain future and capitalise on opportunities. And particularly in this part of the market, given the downside risk that I identified earlier around the sheer number of small caps that can destroy capital, it really is important to understand where things could go wrong. So what do we mean by quality? I often get asked this, given it's quite a common term in our industry, but for us, we are very clear around the factors that we look for. I've spent a lot of time on ESG, so looking at the other four that you can see here under quality. The first, ownership structure. Really, this is about transparency. So transparency, and what I mean by that is just having a clean company structure, visible earnings, and consistent cash flow conversion. So really seeing where the earnings are being generated and how they're being generated. The second one here, business strategy and prospects. We spend a lot of time looking and understanding the industry in which the business operates. So we look for attractive industry characteristics, such as high barriers to entry, the market shares that the businesses have, and importantly, the trajectory of that market share. We look for a clear strategy around how they will be delivering growth into the market over the next 3 to 5 years. And again, I mentioned a sustainable competitive advantage. The third point here is management. Now, experience, execution, and track record is very important for a management team. So we spend an inordinate amount of time evaluating the quality of management we look to invest in. Excuse me, we spend time with all levels of management, but predominantly the CEO, CFO, Chief Technology Officer, Chief Risk Officer, and then the managers below them. And we meet with them at least every 6 months to understand the strategy and the milestones being hit. And we do this because experience is valuable when you need to navigate through rougher waters as well. The fourth point here is the financials. So financials, a very strong balance sheet. We look for good margins, good return on capital. And we've been able to avoid a number of the blow-ups in this part of the market because of the conservative nature of the financials. We look at a lot of off-balance sheet liabilities, such as operating leases, bonding requirements for a lot of the mining services providers, and bring these back on balance sheet. Really, these are considered debt, and you need to understand the serviceability of them. How do we identify quality? It's a lot of hard work. Although, when you take a step back, it's many things coming together. So yes, we have robust detailed research and analysis. As I mentioned, this involves face-to-face meetings with management, but it also involves meetings with competitors, suppliers, customers. How we get our insights really depend on what avenue we take. So it could be direct conversations with the companies themselves. We also use expert networks if there's something that we can't gain access to through our other channels. And all this insight, what it enables us to do is form a very high conviction view around a company. So if any of these change, any of these quality characteristics change, the investment thesis changes as well. So once a company passes on quality, return to valuations. I'm not going to spend too much time on the valuation piece, but we really do focus on different criteria depending on the sector and the industry in which the company plays in. So for example, if we're considering a property company, obviously there's a huge amount of tangible assets. So we look at price to NTA or price to NAV. Very different to if we're analysing a tech company which has virtually no tangible assets and it's all intangible. In this case, we focus on implied long-term returns and the sustainability of growth in profits, in cash flows, and in dividends. So we don't rule them out, but we have a very different approach. So if a company passes on quality and value, then it's considered for inclusion in our model portfolios, and then it becomes a question of sizing and positioning. So the outcome of these two filters is a high quality portfolio, as you can see in the table here. So high quality in the sense of a higher dividend yield, a very strong balance sheet, much stronger margins, and high return on equities and high return on assets. Now the thing I'd like to point out here is really the consistency of our fund. And I looked back at these stats going back 10 years now, and they were very consistent with what you see here. However, the statistics for the small ordinaries were very different, vastly different, and particularly the net debt to equity. You know, I went back into 2009, which was just after, or in the thick of the GFC, and just after that, and that was approaching 100%. So clearly there's been an ROE today is significantly higher than what it was 10 years ago for the index. And that's perhaps an indication that the underlying companies making up the index today are very different to what they were 10 years ago, but perhaps high quality. We don't have even though materials and energy is still a big part of the small cap index, it's not as big as it was. This next slide I find a very interesting one, and perhaps one that some of you have not seen before, and it's really charting our fund's upside and downside capture. So if I can, perhaps I'll take the 5 year, so in the middle of 5 year return, and I'll just explain this in a bit more detail. So an upside capture of 80% means that in any month over the last 5 years where the market has gone up, the Aberdeen small cap fund captured 80% of the movement. So there's quite strong participation in the upside. Over that same period, however, in any month that the market has fallen, the fund has only captured 45% of that downside movement. So in essence, we capture more so we capture a lot of the upside and much less of the downside. And this is really an outcome of the stocks that we're selecting, and also that the main risk assessment is absolute risk. So that's the permanent loss of capital, which is at the heart of the downside protection we strive to achieve via investing in quality companies. So when we have periods of strong market sell-offs, as we did in the fourth quarter of last year, this really comes through for us. So what this has meant is that we've constructed a high quality portfolio, and it's generated superior returns, but with less volatility and risk. And it's really, for me, the way I see it is the disciplined nature of our investment approach that leads to much more consistent outcomes. Yes, returns are absolutely important, but the path that you generate those returns to, again, is very important in itself. And finally, I will leave you, I'm going to leave you with the performance, really, because at the end of the day, it's all good to point to the theory, but you do need to execute and to deliver. And what this chart here is showing you is how our small cap fund has performed since we initiated under our investment process, which is in May 2009. So $20,000 invested back then is worth $70,000 today, so massively outperforming both the broader benchmark, which is the small ordinaries, but also what's considered the higher quality benchmark, which is the small industrials, which strip out the miners. One of the key things here is, you know, one of the big lessons I've learned is around compounding, and compounding is your friend, and something that we should all hold very closely. So to conclude, small caps can be a challenging asset class. However, given the high potential for alpha generation in this part of the market, it's really an opportunity you don't want to ignore. We believe in, and we've actually demonstrated that there are opportunities for outperformance if you have a disciplined approach, you undertake that robust fundamental research, and there's that strong focus on governance. So with all of that, I'm going to leave you with some words of wisdom, and they're not my own, but that of Mark Twain's. So plan for the future, because that's where you're going to spend the rest of your life. And with that, I really would like to open it up if there's any questions that you may have around the presentation. I will do my best to answer.
Thank you, Michelle. That was fascinating. I knew nothing about small cap stocks before that. We do have a few questions here. I'll start with James's. So do you ever invest in small caps at IPO, or do you wait to see behaviours and track record of management?
Yeah, very good question. We do invest at IPO. You know, Net Wealth is a stock that we took up at IPO. It's very rare that we do. And why we did, and I'll just use Net Wealth as an example. Net Wealth had a history and quite a strong history around what they've been able to do in the market. They had the founders of the business still heavily involved. The conservative nature of the management team meant, you know, that came through in various aspects. One of those is the way that they accounted for R&D expenses, so they were fully expensed and still do that, which is quite different to one of the peers in the market. Then the industry itself was ripe for disruption, as we've seen play out, and I think there's still more to come here as well. So yes, we do IPO, participate in IPOs. However, it's more rare than it is the norm for us to partake, specifically because of what you mentioned. It's really important to understand how companies are going to cycle, sort of work through cycles and the barriers that they've created around their business and the moat. So if that's not clear at IPO and with a number of other factors, then we won't participate.
Thanks, Michelle. We've got quite a few questions coming in here. I don't know if you can answer this one based on it being potentially advice. Can you provide your top 5 small cap picks? If not, I might rephrase it and say perhaps 1 or 2 recent trades that you've kept your eye on or have noticed lately.
Sure. It's difficult because how I answer this one. Look, I can absolutely share with you where we see opportunities within small caps. ARB is an example of a stock as well that we, taking a 3 to 5 year view, we're still very constructive on the name. We think that there's significant growth opportunity offshore for the business. And even though US is by far the largest market, it's going to be one of the hardest for them to tackle. A lot easier, I think, is going to be the Middle East. And also they've now got distribution on the ground there. So I think I'd be looking to that market and how they progress there, and also Asia. And given what we've seen with the pullback in the share price, given all the domestic worries around the consumer, again, it's taking a 3 to 5 year view. I think this one still looks interesting. There's a number actually of companies in the tech space, and again, we're very clear around the types of business models that we like to invest in, given where we're at and the run in share prices that we've seen within the tech space. But where there are products that are embedded in workflow cycles that are very sticky to replace, and have got a very strong long-term trajectory from a growth perspective, underpinning that, we're quite positive on. One of these is Pro Medicus. So Pro Medicus is a imagery radiology SaaS provider, and they've just been incredibly successful over in the US with the academic hospitals. And again, I think there's a very long runway of growth coming from there. But again, we're very selective. The way the exposure that we have to this part of the market is very different to what the index indicates. So some of the big profile names, we question the sustainability of the business models at these valuations.
Thanks, Michelle. How do you think Australian tech will go in the next 12 months? Such companies like APT and Z1P have shown great success. Do you think this will continue?
Mm-hmm. We've so I just touched on that as well. Again, I think it's becoming ever more important now to really look at business models. So yes, we have had an incredible performance from a number of these stocks. We don't currently invest in APT, so that's clearly cost us quite a bit of performance. But the reasons for me are very clear as to why we have not. And really, this is a company that I think the product itself is an incredible product. It's a great one. It's clearly done very well. However, my reservations are more around them not seeing a cycle. And when you look at the cohort of people utilising the product, you know, these are stretched consumers that at some point as well, it will come back. And the level of growth that is now implied in their valuation is for this to continue. The other side of it as well is just be careful with the financing and the warehousing facilities that they've got in place. So look, where to from here? Be selective in the names that you're going to invest in. Ensure that the businesses have got dominant market positions. And I say that with, you know, the example of Xero. Xero is a stock that has not only a network of advocates out there, and it's all through word of mouth, but again, it's embedded in the workflow of the customers. They have clear market leadership in a number of countries, and again, through our research, it looks like they're being able to replicate that offshore. Still very early days for them in the US, but UK is certainly gaining traction. So yes, it's a part of the market that everyone is interested in. They're interested because it provides growth, and not many other parts, but I'd be very wary of valuations at these levels.
Absolutely. We have time for a couple of more questions. Do you see ESG alpha primarily being driven by avoiding the downside?
I think it's a function of both. So I agree with ESG providing a framework that companies can abide by, that prevents some of that downside from coming through. So yes, higher quality companies have it, but I also see it as providing the upside over long term. So if you're looking at what drives a sustainable business model, they're the type of companies that get re-rated over time or are able to maintain the rating over time if they execute. So for me, it goes both ways. You know, an interesting thing I'd like to point to here, Ownership Matters. So they're leaders in the governance space, and they've got an index, and I can't give the exact numbers, I don't have them in front of me, but they've actually charted the performance of the bottom quartile of companies in the small ordinaries and how they've performed so bottom quartile in the sense of governance and how they've performed, and they've massively underperformed the broader index. So on the flip side of that, then you'd expect the top quartile of governance companies over the longer term to really outperform. So again, capturing that upside. So I think it can go both ways.
Okay, what are your thoughts on Xero? Is it overvalued currently?
The way that we look at Xero, and we're owners of the company, again, I think this company has got significant opportunities to continue the growth trajectory. And I say that with a couple of things in mind. Firstly, what we saw about 12 months ago was them pulling back their approach in the US. They weren't gaining traction, so they really had to lift their game and look. The playbook over there needed to be rethought. So they've done that, and they've put in some quite senior people and people that know that market a lot better than they did. So again, I think they're doing this in a much more measured approach. They're not throwing capital into that market. They are cash flow neutral now. They actually posted their first profit at the last set of results for the second half of 19. But the UK, what we're starting to see in the UK and what they've been able to deliver from that market is very encouraging. And we've got some analysts over in the UK that follow it quite closely as well, and actually they're gaining significant traction against the incumbent, which is quite an interesting dynamic, given the incumbents typically hold on. So Xero certainly is making traction, and really the big one for them is the US, so we're tracking that one quite closely.
Great, thanks. One more, because there's so many. Is Access Today AXL a small cap you investigated? If so, how did their governance framework stack up?
Unfortunately, I can't go into detail there because it's not one I know very well. If there was, yeah.
No worries, I'll replace that with a different one. In regards to ownership structure, what do you believe is the ideal way to see founders monetize some profits without the market losing faith in prospects of the company? Are all founding shareholder sales bad news?
That's a really good question and a very timely one as well. And linking in Xero, we saw Roger as well sell down a stake. I've got some sympathy for management. I don't think there's a clean or clear answer here. The US have got a slightly different structure around when management can sell down and the periods that they can. And I think we should look to the framework that they've imposed over there as a way forward to eliminate this negative, I guess, view that comes with management selling down. At certain points, look, taking a step back, I think alignment is by far the most important thing. And alignment comes in a number of ways, ownership being probably the biggest way. We've seen a number of companies sell down without them really stepping away from the business. You've also got to consider what the next 4, 5, 6 years for the business looks like. And if the founders aren't the right person to navigate that and to execute on that strategy, it makes a lot of sense for them to step aside and bring in people with the skill sets required. And that's the work that we do at the board level as well. Just get the conversation going and get them to understand that what's required for the next 5, 6 years is not what was required for the past 5, 6 years. So again, to the point specifically around management selling down, it's not always a bad thing. Everyone's got their own lives, but I'm not sure how we can get rid or eliminate the negative connotation that this brings. It can make share prices move quite materially.
Thank you very much, Michelle. Everyone really enjoyed that presentation, and thanks everyone for joining us. We hope you found this really valuable. As a reminder, if you've been online for 30 minutes, you'll receive your CPD point details within the week. And in case you're interested, you can view all the managed funds and their performance on our platform by visiting the Compare Funds and Models page. You can find this on our website under the Personal tab and then Research and Tools. We also have a podcast where we pick the brains of wealth management professionals to uncover interesting insights and opportunities on portfolio construction. Michelle's just recorded one, so look out for that. Thanks again, everyone.